My name is Shane Handy. I'm the founder of therationaltrader.com, which is a trading education service designed to teach how to trade in a very controlled, very methodical way. I'd like to thank you for joining us today. I have a very engaging presentation for you, the title of which is Trade Setups for the 3 Challenges All Traders Face. Those 3 challenges are based upon a core understanding of human nature, which I call market biology, which I will define for you shortly. I'd like to say a quick thank you to Infinity Futures for hosting us today, and also take the opportunity to say a heartfelt thank you to Patrick Zilbauer, who has been my broker for as many years as I can remember. He helped me early on when I was learning and has provided simply excellent service ever since through some pretty tumultuous times. This can be a crazy business, and I can't tell you how helpful it is to have someone that you know you can rely on. I think this is one of Infinity's strengths. Thank you again, Patrick. The nature of today's presentation is such that you should just hold questions until the end. It will be very clear why in just a moment. Let's begin with this observation. There is an often cited statistic that 95% of all new traders lose all their money within a year. 95%. Now, I haven't seen the data, so I can't independently verify it. But my own personal experience bears this out, as does every conversation I've had on this topic with every broker I know. 95% of all new traders lose all their money within a year. So think on this next statement during our discussion today. If everyone is failing at something and you want to succeed at it, you have to do something different than what everyone else is doing. If you want to succeed where everyone else is failing, you have to do something different than what they're doing, because what they're doing isn't working. The question is, why is the failure rate so high? I'm going to share with you what I believe is the answer. We're going to talk about the root cause of that failure and what you can do about it, moving from the general framework for success you need to have in place down to specifics, including what elements need to be present in your trade setups. Before we continue, there are 4 aspects to any discussion of trading that you need to be aware of. I suspect many of you have heard this many times before, but I would request that you not tune out. I have a very specific take on these items that relates to our discussion today. The first is risk. Trading is risky. You can lose all your money. You can even lose more than your initial investment. In fact, you are likely to lose all your money. We just talked about that statistic. One of my goals at therationaltrader.com is to teach you to trade, or to help you to learn how to trade without losing all of your money in the process. Second is suitability. Trading is not for everyone. I did not understand what this meant when I first heard it, but I think I do now. A trader experiences on a daily basis a level of emotional intensity that is simply not part of your average person's daily routine. It's not for everyone, and you may find that it doesn't suit you. And the sooner you know this, the better. I specify checkpoints for you to evaluate whether trading is for you before you invest a lot of time. Third is performance. Past performance is not indicative of future results. This statement is almost a cliche, but it's true. It's just not true for the reason you think it is. We'll talk about this today, but I will tell you now, 2 people can be following the same trading methodology, executing the same trading system, and one will be profitable and the other will not. There is clearly something more at work than just the trading system. Fourth, hypothetical or simulated results are not to be trusted, especially if they are given to you by someone that is selling you a trading system. Simulated results are often produced with the benefit of hindsight, and I promise you, if you give me any data set, I can craft a profitable trading system from it because I already know it happened. More importantly, there is no risk in a simulation or a backtest. And risk is the most important factor in trading, more important than anything else. Risk is the reason one person makes money but the other doesn't, even though they are executing the same trading system, because they each handle risk differently. So a simulated result is not very useful since it's missing the most important element. I will take this one step further and tell you, don't even trust actual results. The financial markets are littered with the corpses of traders who had a great track record until the day they didn't, because they didn't understand the risks they were taking and did not have appropriate measures in place to protect themselves. It doesn't do you any good to turn a profit if you can't keep it. The stories are legion. You never hear about the small traders who blow up their accounts, but you hear about the big ones. My favorite is the emerging market bond trader that made $40 or $50 million for his bank over the course of a few years and then lost $600 million in a week because he didn't understand the risks he was taking and he didn't protect himself. Any methodology you employ to trade the markets must include solid measures to protect your account for the times when the market does not do what you expect, including protecting your account from yourself. And with that statement, we segue into why nearly everyone loses. One way to approach this question is to look at what everyone else is doing and don't do that. Another way is to look at what they aren't doing but should be doing. It turns out that the latter of these two is where we find our answer. When people start trading, they begin by learning technical analysis of the markets. Bar charts, tick charts, moving averages, oscillators, stochastics, etc., etc., etc. And this is important stuff. There is a basic foundation of technical knowledge that is necessary for you to have in order to understand what the market is doing. But notice that I said what the market is doing, not why the market is doing it. This is the first challenge you face as a trader, figuring out what technical method you're going to use. And here is where everyone runs into trouble, because everyone focuses exclusively on learning technical analysis, thinking that this is the primary skill needed to be a successful trader. And it's no surprise they think this. There are hundreds of indicators out there and an endless array of ways to use them, and everyone is talking about all the different ways to analyze the markets. So to a newcomer, it looks like this is where you need to focus your attention. It's perfectly understandable. But this is where everyone falls down. The beginning of understanding why nearly everyone loses money is this. Technical analysis, analysis of the market, is an intellectual activity. Trading is not. Technical analysis is a logical thought process. It's an intellectual activity that gauges the cognitive functions of your brain. Trading, actually placing a trade with real money on the line, real money, your money, at risk of being lost, is not an intellectual activity. A different part of your psyche is involved, a part that has not been developed by your efforts at learning technical analysis. You can be an expert analyst, but still be an infant trader. Technical analysis is a necessary skill, but it is not the only skill you need to be a successful trader. And when you develop your technical analysis skills, you are not developing the skill you need to actually trade with. Remember, everyone is talking about the technical analysis of the markets, but everyone is failing. So if trading isn't analytical or logical, then what is it? When you have something of value at risk, your body reacts the way nature intended it to. And it doesn't matter what's at risk, only that you care about it. The more you care about it, the greater the reaction you'll experience. If someone or something tries to harm you, your body autonomously reacts, and we call this the fight or flight syndrome. If there's a threat to your child, say your toddler steps out into a busy street, your body reacts and you leap into action to save your child. This response is physical. It's in your biology. It's not intellectual. It's not rational. It's glandular. It's also autonomous. You have no control over it. And in fact, you don't want to control it. It's an important part of your survival mechanism as a human being. But it's working against you as a trader. And I'll clarify why in a moment. Your body does not make a distinction between a threat to your life, a threat to your child, or a threat to your livelihood. It doesn't understand there's a difference. It reacts the same way, regardless of the type of danger you're in. When you have something of value at stake, your body responds. And the greater the value you place on it, the more intense the response. When you place a trade, you have money at risk. You value that money, and your biology responds. This is a perfectly natural reaction. But it doesn't stop there, because you have much more than just money at stake. Much more. We need to talk for a moment about why you're trading. Most people are trading because they want to secure a better future for themselves and their loved ones. When you strip away everything else, this is what you find. You want to provide for your retirement, you want to provide for your child's college education, or you don't want to have to worry about being able to provide for them because of the economy or your industry or the decisions our political leaders are making. In other words, you want freedom from worry. which is another way of saying you want control of your own destiny. It's pretty heady stuff when you dig deep, and this is what's at stake, and this is what your biology reacts to when you place a trade. You experience that reaction as fear and excitement. When you place a trade, you have much more at stake than just the money. All the hopes and dreams you have about being successful in the markets are now tied to this trade. All the fear, anxiety, doubt, excitement, greed, and euphoria, all of it is amplified and concentrated down into this one moment in time. And this happens all day, every day when you're trading. You can see the fear in the market every day as traders bail out of positions that are killing their accounts, and the excitement as traders chase a market up or down. Both behaviors are in reaction to a biological response, and both are losing propositions. And now we've arrived at why nearly everyone loses money. The vast majority of traders make decisions rooted in their biology, in their basic human nature. They're acting either in response to excitement or as a means to alleviate their fear or anxiety. And markets have evolved to take advantage of this. They've evolved to take advantage of human nature. This is the reason why nearly everyone loses money. There is a Darwinian process underway. It's been going on for many, many years, and by this point in time is honed to a razor's edge. This is what you're jumping into, and if you don't understand what's really going on, if you don't understand the market dynamics underlying why prices move, then you're going to fail. This makes perfect sense when you think about it, because trading is a zero-sum game. There is a winner and a loser. You are in competition with every other trader out there, and everyone is trying to take money from everyone else. The money that you make is not created out of thin air. It comes from someone else's account. For you to make money, someone else has to lose money. It's more useful to examine that statement from the other direction. For someone else to make money, you have to lose money. This is competition in its purest form. Now, obviously, you don't want to give your hard-earned cash to some other trader, so they have to trick you into doing the wrong thing. Or stated another way, the market has evolved ways to tempt you into doing something foolish, and it does so by preying on your natural biological reactions to having something of value at stake. In order to be successful as a trader, when you are most afraid to do something is when you most need to do it. And when you are the most excited is when you need to be most cautious. Think of your account like a baby you're holding in your hands. Don't drop him. The vast majority of traders make biology-based decisions in response to fear or excitement. If you want to be successful as a trader, you have to make dispassionate decisions that are based on data, not driven by emotion. You want to be on the other side of the traders making these emotional decisions. They are the ones succumbing to the siren call of the market, providing you with the opportunity to profit. Think about it for a moment. Who is taking the other side of your trade? Every trade has a buyer and a seller. Who's on the other side? Is it a newbie chasing the market, or a professional trader who's been patiently waiting for this setup all day long? Who do you want to be? Who do you want to be? The predator or the prey? Because that's the relationship you're in, whether you like it or not, and you're either one or the other. People new to trading spend all their time and energy navigating through the maze of countless technical analysis methods and no time at all on mastering their biology. They are unable to effectively implement their technical method because a different set of skills is required to actually trade in the face of their natural biological reactions to the market action. This is why your actual results don't meet the expectations from your analysis, and it's why nearly everyone loses money. This is the second challenge you face as a trader, mastering your biology. The question is, how do you master it? Even better, how do you get the biology working for you instead of against you? One of the things you hear or have probably heard is that you need to be more disciplined, or you need to follow your plan. This is basically useless advice. It's useless because you already know it. Of course you need to be disciplined and follow your plan. This is not new information. People that are telling you this have no idea what the solution is or even what the problem is, for that matter. You are not a computer program. You can't change a few lines of code and recompile. You cannot decide at an intellectual level to behave differently and expect your body to follow suit. It doesn't work that way. Think of a friend who is struggling to lose weight. Telling them to eat less and exercise more is useless advice. Your friend already knows this. He probably finds it irritating and wants you to stop telling him something he already knows. Much better would be to show your friend how to structure his life so he eats less and exercises more. This is what we do at therationaltrader.com. Through a combination of risk management, trading plans, live trading, and partnering, we show you how to structure your trading so you can develop the discipline you need to be a successful trader. We're going to spend the next few minutes talking about this structure, what elements you need to have in place so that you can overcome your natural biological reactions to the market. What we're talking about doing here is retraining your body. Your body is a biological system, and there is only one way to retrain a biological system, and that's repetition. It is the only way. You must repeatedly experience the situation you're trying to learn and execute the required actions under conditions as close to real as possible. Repetition in a safe environment is the only way to retrain a biological system. I'm going to give you 2 examples from other walks of life and then show you how we set this up so you can learn how to trade. The armed forces and the martial arts are 2 good analogies. In the army, a soldier must be trained to perform under the stress of battle, and the army prepares them for this through endless repetition. Drill after drill after drill. They'll put you through basic training and you'll come out the other side able to field strip a rifle while riding a bicycle blindfolded through a riot. The martial arts are similar. Now, I have a black belt in a Japanese style of karate called Shito-ryu. I was an instructor for many years at the main dojo in Santa Ana, California. In fact, many of the concepts I've implemented at therationaltrader.com have their roots in the martial arts. In the martial arts, they teach you how to block a punch. They'll show you what to do technically, how to make a fist, where to meet the attack, what's the angle of your arm, how to step out of range, etc., etc. And then they have someone try and hit you many, many times. The first time, you're basically terrified. Your body reacts the way nature intended, but through repetition, the fear recedes, and after blocking the 100th punch, it's routine. After the 500th, it's downright boring. It's the same with trading. By the 100th trade, it's routine. By the 500th, it's so automatic, you don't even think about it. It's like tying your shoes. You just do it. The challenge for you as a new trader is to get to the 100th trade with your account intact. Get to the 500th trade with your account intact, and you are well and truly on your way. Our goal then is to get you to your 100th trade with your account intact. So, if you take 2 trades per day, that's 10 trades per week. So we're talking about roughly 10 weeks. This is your first checkpoint. Get 100 trades under your belt while keeping your account intact, and then stop and evaluate how you're doing. What we're doing is allowing you to experience enough trades and market action to beat the fear, anxiety, doubt, excitement, greed, and euphoria out of your system. You are retraining the biological system that is your body. You need to experience the fear, anxiety, and doubt that comes when a trade sets up and you need to enter the market. You also need to experience the anger when the market stops you out and the frustration when the market takes off without you, or worse, and this is the one I hate the most, when the market just barely stops you out before turning and moving in the direction of your trade. In other words, there are times when you need to act to enter the market and times when you need to wait for a signal. Both scenarios generate a biological response that you must experience and process. Your job is to still do the right thing no matter what you're feeling. It's very hard to do, though it gets easier as time goes by. And over time, you learn at a deep level that there is nothing to fear. There is no danger here. And the physiological response, that biological response, lessens to a point where it no longer affects you. Putting it into perspective can help when you realize at an intellectual level that this trade is just one trade. It's one trade out of 500 you're going to take this year. That's 1/5 of 1% of the trades you're going to take this year. It may be profitable. It may not. It does not matter. We only enter the market when we believe the probability has shifted in our favor, so we know it will work out for us in the long run. The key is to build the trust in yourself that you're going to follow your rules. You're going to protect your capital. We'll talk about that next. In order to set yourself up to succeed, you need to structure your trading so that you can build that trust in yourself. To do this, you need three things: an environment where you can experience what you need to safely, an understanding of what you need to do technically, and a guide or a mentor or a teacher to show you the way and help you stay on the path. At therationaltrader.com, we've created a program that implements these elements. The guide is the live trading room. The technical understanding is the trading plan, which is executed live in the trading room. And the safe environment is the set of rules that define your risk and how you'll protect yourself. We're going to focus on setting up a safe environment to trade in first, because for learning to trade, it's the most difficult element to deal with. In the armed forces, they'll teach you everything you could ever possibly know about that rifle, but they don't give you live ammunition while you're doing it. In the martial arts, they employ gloves and pads to avoid injury. In trading, a safe environment is one where you cannot damage yourself too badly if you make a mistake or lose control of yourself. This equates to taking a small loss rather than a large or catastrophic loss. Now, it's quite a bit more challenging to set up a safe environment for trading than it is for the armed forces or martial arts. And the reason is you must have real money on the line or you're wasting your time. You should trade on a simulator only as long as it takes you to learn the trading software and your trading system. On a simulator, you are not developing the primary skill you need to be a successful trader, because with nothing at stake, your biology is not engaged. Since you have to have real money on the line, you have to be trading in live conditions. Live conditions means you are trading against professionals. It also means you have to wait patiently for a trade to set up before you can practice your trading skills. I cannot think of another case that's like this, where you have to learn in an environment against professionals who are not your friends. It's one of the reasons it's so hard to learn to trade. Imagine learning a martial art with a training partner who is a professional fighter who is trying to knock you out. This is the third challenge you face as a trader. There is no practice environment. You must learn to trade in live conditions. Think about the martial arts. It is relatively simple to set up an exercise where someone or a series of someone's tries to hit you in a specific way and you practice how to block. You feel fear as nature intended, but it recedes when you realize two things. First, the techniques for blocking the punch are effective and work well. And second, when you do miss the block, your training partner does not really want to hurt you, usually, and will pull the punch if you miss the block. In trading, we cannot set up an exercise like this. You have to wait with live trading conditions until a trade setup comes along, and then practice your trading skills by executing the trade the way you've been taught. This makes the process very inefficient. Live trading conditions are a requirement, and you must participate in the market and trade live with real money on the line. This is the only way for you to experience what you need to as you work to master your biology. The techniques we teach you for responding to market action are effective, but the market will not pull its punch. It will hurt you in every way it can. The traders on the other side of your trade want your money and will take as much as you will give them. You must protect yourself and your account. That protection begins before you ever sit down in front of the screen to trade. To set up a safe environment for trading, you define your risk in advance. You set up your software to implement that risk management, and you have an externally imposed control to stop you when you exceed your risk parameters. At therationaltrader.com, we do this in what we call the business plan, which is one of the 4 elements of the program. It's in the upper left there. This is the most important thing you need to do if you want to learn how to trade. The business plan is a 3-page document where you define your capital allocation and your risk management, also your goals. For example, if you've allocated $5,000 to a market and you want to take 2% risk per trade, you're going to risk $100 per trade. You set up your software to automatically place your stop so that you're risking $100. If your stop gets hit, then you're taken out of the market, period. No exceptions. Then you wait for the next signal. Our rules state that if you take 2 losses in a row, then you're done for the day in that market. So your maximum daily loss is planned in advance. It could be more because of market conditions, but this is how you approach managing your risk. You call your broker and you give them this number, add a little padding to allow for slippage, or if your software supports it, you implement it in the software. If your daily loss exceeds this number, the systems will automatically liquidate your positions. You can think of this as an externally imposed control to make sure you are protected. Protected from the market and protected from yourself. You should not think of this externally imposed daily loss limit as a stop loss. That's not what it is. It's a safety net, and it should never be needed. It's like fire insurance. If it gets triggered, you've done something wrong. What we're doing here is making sure you survive. You have to survive a statistically normal streak of unprofitable trades. In fact, this is how the professional trader defines that risk. But as a student trader, you also have to survive mistakes. And you have to protect yourself from yourself. We're going to talk about trade setups next, but before we do, let's summarize why nearly everyone loses money. The primary reason is because of a fundamental misunderstanding about what skill they need to learn. The secondary reason is the fact that they have to learn in live conditions. People new to trading spend all their time and energy learning technical analysis methods and no time at all on mastering their biology. Technical analysis is a logical thought process, but trading is not. Trading, actually placing a trade with real money on the line, real money, your money, at risk of being lost, engages a different part of your psyche, and a different set of skills needs to be developed to actually trade in the face of your natural biological reactions to the market. The trade setups that you use need to incorporate this understanding of market biology. You are struggling to deal with your natural biological reactions to having something of value at stake. So is every other market participant. And when we say the market, what we mean is all the traders who are trading that instrument. That's the market. It's a bunch of people, all of whom are human and are subject to the same biological reactions to the market action that we've been discussing. Your goal as an aspiring trader is to work through the biology-based issues within yourself and recognize those same issues being expressed by other market participants and then use them to your advantage. Which brings us to the professional traders. They're human just like you and me. They've just seen enough market action to purge the emotion out of their decision-making process most of the time. Remember the trader from the beginning of our discussion who lost $600 million in a week. He was a pro, and he could have gotten out for scratch. Instead, he let fear get the better of him. And don't think the professionals are infallible. They're not. They get the direction wrong just like you and I do. The difference is they understand they're operating in a probabilistic environment with a large random component, and they keep their losses small. Being a successful trader comes down to outthinking your opponent. They're trying to take your money, you're trying to take theirs. So when you develop or evaluate a trade setup, you want to know what aspect of human nature is being taken advantage of. How are the market participants reacting to the action, and is there an edge for you? What is the person on the other side of your trade thinking? This is the key. What is the person on the other side of your trade thinking? You want to find the situations where the person on the other side of your trade is absolutely desperate or foolish. You want to find the emotion in the market and take the other side. You want to find the fear and panic, the excitement, and calmly, rationally take the other side. This is how you succeed day after day, week after week. Don't get caught up in the technical aspects of trading. Understand who you're trading against. By way of demonstration, let's go over an example you see every day in the markets. Consider a group of professional traders trading moderate to big size that see the market advancing, and their assessment, right or wrong, is that the market will continue higher. They want to get long, but they can't go long at the market. They drive the price up and get a terrible fill. They know that the likely outcome, the probable outcome, is that the market will pull back for reasons I'll describe in a moment. So they identify where support is, and they place their orders or prepare to buy below support, and then they wait. In the meantime, newer traders chasing the move up out of excitement and fear of missing out have been buying. What happens next is the traders that got in early start to take profit, and the price advance stalls. This selling pressure drives the price down. The newer traders that chase the market up out of excitement and greed and fear of missing out are now taking losses and getting stopped out. The smart ones are, the ones that are using stops. This adds further selling pressure, pushing the market lower. What you are seeing is basic reversion to the mean price behavior. You see it every day in every market. Consider any chart. When you look at the peaks and valleys, at the peak, someone was buying there. A lot of someone's actually, and they all lost money. There are two categories of sell orders sitting below support. The first are stop orders for the traders who are long. Some are protecting gains from an earlier entry. Others are stop losses for the newer traders who got caught up in the excitement, chased the market up, and bought at the highs. These traders are feeling some pain. The second category are sell stops for new entries short. These are mostly inexperienced traders who are shorting the break of support. New traders like to short breaks of support and buy breaks of resistance. It's a very seductive trade. Note the word seductive. It's easy to see the trade set up and identify where the entry is. It's also a trade that can run nicely and take no heat. Newer traders are forever looking for trades that take no heat because they have trouble dealing with their fear when the market moves against their position. Unfortunately, the odds are against them. This is a low probability trade. The majority of time they will get stopped out on normal price fluctuations as the market thrashes around at support, or on a complete reversal if this turns out to be a standard pullback into an ambush zone. Which brings us back to our professional traders. They are waiting to buy below support. They're like spiders who have spun a web and are waiting for a fly to come along. The market breaks support and the two sets of stop orders execute and drive the price down into the professional's orders. These orders get filled, absorbing all the selling, and the market bounces up on the strength of all the buying pressure found below support. As the market advances, the newer traders that shorted the break are now getting stopped out, which adds fuel to the advance and the market doesn't look back. What you're seeing here are the market dynamics of a standard ambush trade, something you see all the time in the markets. When I look at this chart, I see two places to enter. At the peak, the market is moving up strongly because people who are short have had to cover. They can't take the pain of their losses anymore and they're bailing out. You want to wait until the last exhausted, pain-racked short has covered, and then wait some more for the people who got excited by the market action and chase the move up. Wait for the last of the fear of missing out crowd to buy, and then step in and take the other side. This is a perfectly reasonable place to short, and it would not be unusual for this to be the high of the day. The other entry is at the valley of the pullback, taking advantage of the natural ebb and flow of the market as we've just discussed. Wait for the longs that relate to the party to cover, then take the other side of the people chasing a low probability break of support. Now, let's look at this on a real chart. Okay, so this is AT charts, and I've turned off the pieces that I don't need in order to describe these the two trade setups I want to show you. The first trade set, actually we need to get oriented here. So on the left here, green line, stock market open, 6:30 a.m. Pacific. On the right, the stock market close, 1 o'clock Pacific, 4 o'clock Eastern. I'm on the West Coast, so all times are Pacific. And then 9 o'clock here is this magenta line. That's the end of the morning session, and I'm usually done for the day by then. And then 7 o'clock here there's often news at 7, so I just have the AT charts automatically draw a line there. And then these light gray areas are blackout periods. I won't take a trade in the first 5 minutes after the open, nor 5 minutes on either side of a news event. So there's built-in studies in AT charts that lets you draw those lines or those areas like that. Very, very useful. This darker transparent gray here is just showing me the first 15 minutes. Let's focus in a bit here on just this piece. This was Monday the 31st. It was a very big gap up. And the market was a little tough to read. I got the first extreme tick reading of the day right in here. All right, and the trade setup is the first extreme tick reading of the day followed by the next extended move reversal signal. So an extended move reversal signal is a pattern of bars that I've developed that represent a change in direction, but only when you are far away from the average, if that's the extended part of the extended move reversal. So the concept here is that even if I have the direction wrong, in other words, even if the market is not turning here, but is instead just going to continue down, then I have a reasonable probability of getting to the midline and getting to scratch. okay? And often it's not continuing down, it is turning. And that's the case you see here today, where I got the first extreme tick reading, I think it was on this bar right here, okay? And I just waited for the next price reversal pattern, okay? Your entry is right here with a 4-tick stop. Now, I didn't get filled here, actually. You get touched but not filled. A 4-tick stop. All right, instead, on this up bar, I then went in right here with my stop right there. Okay, and then I also, on this break of resistance, because you're in a squeeze, I added. All right, so I have, you know, an entry here and then an entry here. Exits were plus 20, and then the trailing stop management gets you out right there. Okay, because you're getting a reversal signal in the other direction. Okay, so plus 20 is something like right there. There's not that much to be had here. This is a nice little 5-point bread and butter move. Actually felt lucky to get it since we'd gapped up something like 20 points or something. It was crazy. The other thing that's going on here is you're getting 2 of these extended move reversal signals. You're getting 2 complete reversal patterns. So you're really extended is what that means. And you're getting it again up here, actually. So if you were of a mind to short, you can short based on these signals here. I did not. I just took the long. Okay, let me find another example for you. Before I do that, I need to explain what I mean by extreme tick reading. This is dollar tick. This is actually set up in a different platform. I haven't set it up in AT charts yet. This is dollar tick, and it's the number of stocks upticking versus downticking on the NYSE. And the lines I've drawn here are plus and minus 600, 800, and 1,000. Anything beyond 800 plus or minus is an extreme reading, and that represents excitement in the market or exhaustion, especially if you've been ranging throughout the day. All right, we ignore the first 5 minutes, so this doesn't count. This here was minus 798. That was close enough for me. All right, and so that is why I took this trade here. All right, now this adds validity because you're also getting a second EMR signal. So that's the second trade setup I like, is a double EMR signal. All right, so now let me go find another example for you. This is 328, and first extreme tick reading is right here. Next EMR signal is here. All right, this is actually difficult. You're not able to get in with a 4-tick stop. And this is generally the problem. A lot of people think, wow, you're going to get stopped out on a wiggle a lot with a 4-tick stop. It's not the case. We're using a 4-tick range bar chart here and a very precise method for entry. Instead, what happens is cases like this where you can't get in because you need a pullback here to get filled. The actual entry doesn't show up until this pullback here. You get a signal right there to short. So then you get in off with your stop up here, okay? And that means you're getting in right there, okay? Catches this nice down move. All right, let's look at the day before. This was Friday, the 28th. Let's look at the 27th. Here is Thursday, the 27th. Yes. Now you wanted to be long here, but it didn't quite set up. And so you end up missing this here. So you just wait for the next signal, and in this case, you're either looking for a pullback to continue the trend, or what happens first is you get an extreme tick reading, followed by the next price reversal pattern. You then get another EMR signal. So now you've got 2 things working for you: a double EMR plus an extreme tick reading. Your entry is right here, okay. And this falls very nicely for you. I caught 10 points here in this trade. Now, I want to point something out to you. That is not an easy short to take. Okay? You have to really train yourself to overcome fear and anxiety when you short the market right there, because that looks like the market's screaming higher. But the first extreme tick reading of the day, followed by an EMR signal, is a solid trade setup. Very, very nice probability. Your challenge is often is getting in. Okay. Sorry about that. So here again we have an extreme tick reading followed by a double EMR. Either one of these by themselves is enough. Both together is wonderful. When I get two EMR signals like this, I'm looking for the break of support or resistance at support in this case that's set by the pattern. That's down here. As soon as I get that, that's really a strong indication that the market is going to make, you found the turning point. And so you open up your targets. My default targets for the double EMR signal is plus 20 and plus 40. Okay, on 2 contracts, risking 4 ticks each, so $100 of risk. All right, I have, let's see, 2 other examples to show you, and then we will move on. Okay, here we are at Friday, March 21st. There's actually some nice looking longs down here, but the first extreme tick reading is right here, and then next EMR signals here. Your entry is right there, a little higher actually, with your stop up here. Okay, and then you actually get a second one. So as soon as you break this, you know you're in for a nice ride. You can actually often go in on this break. You could also bid back, but this catches, I caught 10 points here. It actually goes quite a bit more than that, but I exited it at 10. Let's look at, this is Friday, let's look at the day before Thursday. This marks the end of my prepared material. I want to thank you for your time and attention. I hope you found today's presentation enlightening and entertaining, I hope. I recognize that I did not give you enough information on the ES trading program and trade setups to properly evaluate them, particularly with the information I presented today. The reality is there just isn't enough time. So I've scheduled a follow-up webinar to go over the complete ES trading program tutorial that I use here at therationaltrader.com. That is scheduled for this Saturday, April 8th. It's not April 8th. April 12th, Saturday, April 12th at 8 a.m. Pacific, 11 a.m. Eastern. If it will be recorded. It's 2 hours long. I've scheduled it for 2 hours. We'll get as much done as we can in 2 hours. It will be recorded. So if you have a scheduling constraint, just sign up anyway. And you'll get a link later that day. It will be a full HD recording. I'll send you the link via the interface here. Or you could go to therationaltrader.com and click on webinars and sign up that way. We're going to take questions next, but the question I get the most often is, can I really learn to trade? At the beginning of our discussion today, we talked about the 95% of all new traders who lose all their money within a year. And that if you want to succeed, you have to do something different than what they're doing. So to answer the question, if you continue to approach learning to trade by focusing on improving your technical analysis skills, then you are doomed. You're focusing on the wrong thing. You're doing what everyone else is doing and will achieve the same result. If instead you change your focus to one of mastering your biology, to retraining the biological system that is your body, you will create a mental framework that protects you from the behaviors that destroy most new traders. And then absolutely, yes, I believe you can learn to trade. When you know what to focus on and what to do about it, you can progress from a newcomer flailing about in danger of hurting themselves to a calm, rational trader. And this is what we do every day at therationaltrader.com. One last thing before we go to questions. One of my goals at therationaltrader.com is to remove the barriers to entry for people who want to learn to trade. What I like about Infinity is that you can go to one place and get your complete setup, charting, data, trade execution, and brokerage services. That's very simple, very easy to do. The other barrier is cost to learn. So I've set up a special discount for Infinity Futures customers. Now, before we go over the details, I want you to understand there are no hidden costs. I charge a monthly fee and nothing else. The charts you saw earlier have custom indicators that you get free as part of a subscription to my service. You don't have to pay for them. Okay. In fact, the entire workspaces are built and ready for you just to install onto your computer, and you're up and running. There are no indicators to buy. Okay, I want to make that clear. I see this with so many other services. You sign up and then suddenly you have this big cost of extra stuff you have to buy. Every custom indicator I use is given to you free of charge, and will continue to be done that way. There are no other extra costs for the system, no special training webinars that cost extra. Just come and trade with me and learn. We'll learn together. It's one flat fee per month. That's it. All right. The normal price is $195 a month, but if you're an Infinity Futures customer, you get $95 per month for the first 6 months. Okay. So that's basically half off for 6 months. All right. What's going to happen is you're going to discover in the first month if you can do this or not. You're going to have a very good sense for whether the way I approach the market fits the way you can look at the market, whether it fits your personality. If it does, your next checkpoint is 3 months in. All right, so you're going to spend 1 month's fee discovering, can you do it? That'll cost you $95. And then if it does, you're going to spend another couple hundred figuring out, can you actually do it? Can you overcome the internal battle that you have to go through? Can you beat the fear, anxiety, and doubt? Okay. So with that, let's go to questions.